Right now, without further ado, time is 7:03. I would just like to hand over the time to Mr. Zhang. Mr. Zhang, please.
Yeah, thanks, everyone. First of all, I need to apologize because our initial topic is China macro. But following the recent market turmoil, we think the tariffs and also the sector-specific developments may have an even bigger impact on China and Hong Kong stock markets, at least in the near term. So the content will be a bit off topic today. It's not quite China onshore macro, but we will start from the what happened to the latest market volatility, and then how the Hong Kong or China Hong Kong stock market would perform under current market environment. So I'll start from this angle. So that's why the topic is more like asset allocation strategy. So our presentation today is divided into two parts. First, we can discuss the macro and also the political chaos recently, and then we can touch the AI-related investment opportunities, such as the Hang Seng Tech, which is mainly comprised of the Chinese tech leaders. And after that, our friends are from the PSPL will highlight some relevant ETF strategies. So to understand the recent market turmoil, so first of all, we need to understand the globalization process in the history is actually based on this US dollar, which is acting as a dominant currency. And more specifically, the US export deficit is due to the import of the non-US goods and also the services in terms of the US dollar. And these are, as shown on the left-hand side, explain the US high correlation with the global economy, which means if the US they see a recession or slowdown, then the global economy will also may feel pressure, and the vice versa also works. When the global economy will be dragged down by these, let's say, tariff war, the US economy will also be hurt. And after trade war 1.0, even China's trade surplus versus the United States fell in the middle. The other economies rose accordingly to fill this gap. And in addition to the bilateral trade flows, the dollar denominated, let's say the credit, deposits, and dollar denominated assets and also liabilities, they interconnect the US with the non-US economies. They create another bilateral flows, which is the capital flows. And by leveraging this financial or so-called banking liberalization and the expansionary capacity of the US fiat currency, the greenback, the dollar system is actually penetrating the globally under a unrestricted capital mobility. And for other global economies, they also accumulated a huge dollar balance sheet with the foreign investors owning a large amount of the US securities, mainly bonds and followed by some risky assets. So as a result, while the Fed's the monetary policy is to target the domestic, let's say the inflation and also these and unemployment rate, it can easily have a global impact within this dollar ecosystem. And in the meantime, the US military power also provides an indirect protection and helping the US corporates benefit from this globalization process. So if we travel back, let's say to 24 years ago, 2001, when China joined the WTO, in fact, more labor forces were included in this so-called dollar system, and shifting the dollar wage to a more efficient countries like China, and also leading to a flattening of the Phillips curve. Then here, the Phillips not refers to Phillips securities, but refers to the a theory talking about, let's say, in the past, if you want to raise your GDP growth. then you need to lower your to lower your unemployment rate and raise your inflation. But this round, because of this globalization, this flattening of the curve is actually pushing the inflation down. And in other words, the stimulus within the domestic economy, the creating demand, then generating inflation, this kind of model is actually no longer working. And globally, it also lead to a DM and EM divergence. For example, the DM economies are now with a low interest rate, low inflation, and low growth versus the typically the EM with a high growth and more sensitive to inflation and typically with a higher rate. This is because the DM market, the developed markets, they're shifting the investment activities to the emerging markets, and emerging markets on the other way around to supply the working force, cheap labor, and also the cheap commodities. So it creates some deflation pressure. But all in all, we believe the US corporates have been benefiting from this globalization for decades. On the one hand, they gain market shares from both DM and emerging markets globally. But on the other hand, they enjoy cheap cost through utilizing the materials, assembling, and also the production between the different countries. And more importantly, they can raise dollar in terms of debt or in terms of equities. And sometimes these costs can be even cheaper than the sovereign debt that denominated in other currencies. And they can since they are also has a global presence, they can arbitrage the global tax regime to keep the profits away from the U.S. government. For example, the U.S. Biggest pharmaceutical firms, which means even the U.S. firms, their domestic tax paid is very at a minimal level. And from an investment perspective, the dollar reserve earned will in turn participate in the global asset allocation. So what went wrong after the COVID period? First of all, the corporate tax revenue has been relocated, as mentioned, to global corporate dollar reserves, not an income tax to the U.S. government. That's why the Trump or the U.S. government they want the tariff war, and what's behind is actually what they need money. And second, due to the COVID stimulus, starting from 2020, 2021, there is a surging net interest payment due to the high interest rates and also due to the short-term funding features. They're causing some refinancing problem. So the net result is that on the one hand, yes, the US Treasury is partially benefiting from the global financing benefits because they have a very deep market with abundant sufficient liquidity, but also partially damaged by this global tax regime arbitrage, which means the US government didn't take much benefit from these their corporates global presence. And this is the reason is quite simple because the sovereigns or the governments, they are constrained by the country, by their country, and households is also constrained by their nationality. So they don't have a so-called cross-border identity as compared to their corporate department. Then that's why a corporate they enjoy the benefit, but from the government side they don't. So these are, if you could read this together with the escalating tariff wars in April, these are pretty much explain the market volatility for this month. And there are three major de-risks. One is about the de-risk from the U.S. equity market. The other side is the US dollar, and the third one is the US debt sustainability concerns. And more specifically, the tariff uncertainty, they hurt the US and also the global stocks, and some flows are shifting away from the US. Also drag down the US dollar, while the worries about the US government sustainability and also the liquidity also pushed the yield up. That's why we see a very EM-like trading pattern for the US dollar assets in mid-April. But on a positive note, the market tension is a bit in late April after the US or Trump may reduce some uncertainties regarding Doge and also reconsider the tariff rate applicable to China, which used to reach a very crazy level. But why this impact is so broad this time? I think the reason is also quite straightforward. This is because now the Trump has a war against not only against China, but almost against the whole world. For example, more than 50 countries now that contribute to the US trade deficit may face a higher tariff rates, but the subsequent negotiation process and also the potential countermeasures by other countries are still unpredictable. So, regard of the final impact, the probability of a recession, thanks to this tariff war, is anyway rising over the next 12 months, and consumers globally may choose to save instead of spending, and so as to corporates, which will reduce their capex due to the increased uncertainty. And moving to the equity market, to the US stocks, as market comes down these days, we should know that yes, the US stock decline in April is more of an event-driven decline because the earnings expectations for the US large cap index remain strong, where next the forward 12 months EPS is still on track for roughly a two-digit growth. And looking forward in the near term, the US equity market is highly depending on the negotiation and also the implementation of tariffs. For example, the rumor of this or the expectation of this 90-day tariff pause at least push the S&P index in this month surged more than 8% intraday after the declines. But in the future, we still be more selective in the US stock market. For example, within the US, the large cap tech firms may outperform the small cap counterparts due to the higher elasticity with the macro tailwinds, such as the potential easing stance from the Fed in the second half, and also the trade partners if they can reach some deals. But what is the implications for the global stock market other than the US? Before any potential policy positive surprise in the policy side, it seems the market volatility may continue, as indicated by the VIX, and also the investors' tendency to protect the downside. Those kind of movements is still in place. But if we look beyond the US equities, we do see the flows are shifting into the European equities, which saw a better year-to-date total return, partially driven by the stronger euro versus the greenback, and also partially driven by the resilient stock market, thanks to the core country spending plans, let's say from Germany, and also the relatively cheap valuation. And as for Japan, well, future Bank of Japan hiking can be a headwind. The inherent recovery driven inflation should support its stock market. And more importantly, despite some China's macro headwinds and also the tariffs, the China growth stocks, especially the Hang Seng Tech stocks, which is mainly comprised of the software and hardware giants in China, should still continue to benefit from the AI breakthrough and also the Chinese government support. And this came to the second part of this presentation, because even considering the year-to-date Hang Seng Tech rally and the Nasdaq decline, the formal valuation is still meaningfully lower than the latter one, maybe 16 versus 20 something. Thus, the fundamental factor will place a trigger, a more important role to drive the Hang Seng Tech stocks. And as mentioned in the past, maybe in the previous sessions with Phillips, the US dollar move, it may impact the sentiment against the emerging markets, or including the China and Hong Kong stocks. And the logic is also quite straightforward. As the weaker US dollar may imply the US growth at risk, or the subsequent future rate cut, and in turn benefiting the emerging market equities. And as shown on the left chart here, we can see that the Hang Seng Tech stocks, the index, has a meaningfully negative correlation with the dollar index, which means when dollar went strong, it has some downside pressure, but when dollar went weaker, it had some upside pressure. And even for the even for the movements since the mid-April, it still follow the same pattern. And as shown on the right-hand side, in addition to the China and Hong Kong stocks, the India stock is also a main beneficiary of the emerging market equity inflow. And to some extent, China and India are competing each other. And in fact, over the last several years, the flows are actually leaving China, and those flows are primarily flowing into India, partially because of the tight regulation within China on certain sectors, and also because of the China Plus movements, such as the shift of the supply chain to Southeast Asia and also to India. But if you look at the chart, the older three chart actually, since September 2024, the flow pattern reversed. And set the valuation aside, India in general has a faster economic growth than China, and China is still suffering from the domestic macro headwinds such as property consumption and also the upcoming export pressures. So these reversal of the flows are from, let's say, back to China. It's a bit against the intuitions. We can always let's say to find some reasons from the valuation side, but we have to highlight here is that the China Hong Kong stocks valuation was already cheap for several years. So why now? I think that's something that is something we can figure out. So more clues actually can be found from a time series of the flows into and out of China, let's say in the recent 2 years. And as shown on the left, top left, the active funds, they started to reduce China since 2023 on the back of macro concerns following the China's reopening, because at the time, China, even after the reopening, China didn't see a very strong recovery. And this trend even lasted until early this year. But comparatively, if you look at the chart in the bottom left, the passive funds flows didn't react that aggressively over the same period, but rather increase their weights since September last year. And also, as compared to September 2024, which a market saw a broad-based rebound from its previous depressed valuation, it seems the tech-driven rally early this year, as shown on the right-hand side, can be more sustainable and continue to drive the China Hong Kong stocks. The global fund manager survey also echoed this trend, because as compared to the end of last year, there are more long China tech voices, and more investors expect Hang Seng to outperform as compared to end of last year. There are also some increasing confidence of the China's economy and also the let's say the policy easing potential. Though at the current stage, we still prefer Hang Seng or Hang Seng Tech stocks versus the China onshore stocks or China A shares, because those onshore stocks, they mainly focus on the traditional sectors like the financials, industrials, and consumption, which is closely related to China's macro recovery, which is still under pressure and takes a longer time to recover. But comparatively, the Hong Kong stocks tilt towards the new economy, also with a more growth potential. And the strategic index weighting also echo the case for the Hong Kong stock, because the so-called Chinese elements in the MSCI Equi, the All Country Index, and also the MSCI Emerging Market Index are both dominated by the Hong Kong Exchange listed stocks, and followed by the Shanghai and the Shenzhen listed equities. And page 20 actually gives a more direct comparison. The onshore stock market, as shown on the right-hand side, has a substantial exposure across the sectors with a lagged performance and a lagged earnings growth. For example, the more deflation-dragged sectors like the properties, materials, industrials, or even the consumer staples and healthcare, they represent more than 40% of the CSI 300 index. But if we talk about offshore China equity index, these traditional sectors just account for less than 18%. And furthermore, the MSCI China index, now they only have roughly 13% in the onshore weight, which means the rest are all offshore weights and mainly listed in Hong Kong. They consist of large proportion of internet, semiconductor, and automaker stocks, which deliver the best earnings, at least in the past 3 years. So in other words, the sectors with a higher growth, such as consumer discretionary, communication services, and also IT, or in short, the high quality shareholder return group, they weight higher in the offshore China equity index or in the Hong Kong equity index as compared to those 3 years ago. But those are macro linked groups weight, or the traditional sectors, they dropped over the same period. And more importantly, the high quality group also have a continuously higher ROE in the past 5 years as compared to those sectors dragged down by the slowing macro. So more importantly, the launch of the DeepSeek, as we mentioned at the beginning of this year, they provide us not only the tactical reason, but the strategic reason for holding the Hang Seng Tech stocks. As the one reason is because the irreplaceability of the high-end semiconductor hardware has been weakened because the open source feature and also the cheap cost feature of the DeepSeek and its potential future version, they raise a question mark about the previous heavy capex model. And the second is about the software side, because the cloud computing and also the software apps are expected to have a great development, leveraging the China's strengths at the apps level. So these provides a very good opportunity for China and Hang Seng Tech names to catch up with their US peers, given its still promising earnings with a relatively reasonable valuation. And also, the Hong Kong market also has a very good feature. This part is very similar to the US stocks. It's the massive buyback activities, and these buyback in Hong Kong, they boosted the confidence through the price support, through the return of the cash, and also through the enhancement of the ROE. So the growth seems, and with the market structure advantage in Hong Kong, they at least attracted some southbound fund flows from the China onshore investors. But more encouragingly, since we are based in Singapore, we also see some foreign investors. They buy more Hong Kong and Hang Seng Tech, such as the ASEAN investors. We all understand that, as we mentioned at the beginning, we all understand the market has a very high expectation for China stimulus and expect this to support the China macro side. But we should notify that China now is facing some dilemma to balance the aggressive fiscal spending and also the more monetary easing and also the renminbi stability. And this is especially true on the back of the current tariff war situation, which is not definitely not done yet. So from a macro perspective, the demand stimulus definitely it will be there, but it can be marginal and with a focus on high quality development. But from a micro corporate perspective, the more friendly tone can be even more precious at the current stage, such as more room for the private-owned enterprises developments support of the technology in innovation. Even this is start from it's like a reverse inquiry. It's from the DeepSeek. But it's good enough because now the government notified this the support of the innovation and also the debt resolution and as well as some of the equal access to the basic infrastructure. Those kind of ease of restrictions can anyway support the China's private sectors. So these kind of measures combined with the AI breakthroughs, they provide golden opportunities for the China tech leaders listed in Hong Kong to provide some more potential for the outperformance. Here it's a list of the Hang Seng Tech Index major holdings. I will not read them one by one, but I will just give you some quick examples. For example, Tencent's revenue, they may grow further, driven by the online games or advertising, fintech, and also the business services. And its AI capex is expected to grow. And in the meantime, Xiaomi's future is more on its EV business, in addition to its existing mobile phone production line. And Alibaba, on the other hand, is benefiting from a relatively healthy goods and services consumption. Of course, the ban on the certain chips exports to China may impact its capex plan, but the increasing reliance on the domestic chip producers may help mitigate this and also help the China's hardware producers. And as for Meituan, well, the JD's participation in takeaway market may impact the whole their own market shares. The whole market structure is a little impacted because Jingdong or JD they need to subsidy more to gain more market share. But anyway, we have both stocks in our index. So in my last slide tonight, before hand over to our friends from Phillips to highlighting the ETF strategies, I just want to highlight that Hang Seng Tech, they includes the 30 largest China tech names, tech related companies are listed in Hong Kong, and Hong Kong security trading activities highly concentrates on these index constituents, providing a sufficient liquidity to these stocks. So of course, the Hang Seng Tech, they are also dropped from its recent peak in mid-March due to the escalating tariff war, but it did manage to recover after the Black Monday on April 7th, and since then they keep in most days they keep rising. This is because with only 10 to 20% overseas revenue exposure, the Hang Seng Tech names are more impacted by the technology improvements and also the China's domestic consumption recovery than the external trade uncertainties. And with the still promising earnings and the fair valuation, we think the Hang Seng Tech, they still has the potential to grow further. And April 7 can be treated as the near-term support level, and this level also not far from the floor built on the October 17th last year after the September rebound in 2024. So that's why we now at the current stage we are still quite constructive because we know where the floor is, but the upside potential are still there. And if we have to pick a main driver or upside driver for Hang Seng Tech for the rest of the year. Let's say the China macro recovery, the tariff war between the U.S. and the world, and also the Hang Seng Tech's the underlying names earnings prospectus, then definitely we believe the underlying firms outlook maybe can overlay the rest overlay the rest, such as the macro headwinds and also the uncertainties around the tariffs. So that's why now is a good timing to continue to consider the Hang Seng Tech investments. So perhaps I can pause here, then the Phillips can share more about the specific ETF strategies. Then we can discuss more in details about the Q&A regarding the recent market developments and also the Hang Seng Tech potential performance. Thanks.
Let us begin with 3033 Hong Kong, the CSOP Hang Seng Tech Index ETF. So by the way, this was the world's first ETF that began tracking the Hang Seng Tech Index back in August 2020. Okay, making this somewhat of a pioneer in giving instant access to Hong Kong's top tech and innovation names. So firms, as earlier mentioned by Mr. Zhang as well, firms such as Tencent, Alibaba, Meituan. I will talk about all these a little bit more later. I'm sure you want to know what are some of the drivers. We talk a little bit about AI. So what are they doing in this AI space as well? I want to cover a little bit on that later on as well. So over the past year, this ETF has returned a 45.6% return. That's almost half your investor capital. Okay, the benchmark index did do well too, and 3033 came very close when tracking it. So naturally, it being heavily weighted in tech, it can be a bit volatile, as you can see from the 1 month performance dip. But if we do look at the bigger picture performance, we definitely can see the momentum there as well. So if you believe in the rebound of China's tech sector, the recovery, or you want exposure to high conviction names without needing to cherry pick like the individual stocks, this ETF is for you. We'll go through more later as well. The management fee is 0.99%. You can see over there annually, a quarterly rebalancing. So it stays aligned with all the sector movements and the index compositions as well. Okay, so what powers this ETF? Okay, so let's take a look at the companies behind this. So as you can see from the chart on the left over here, I just want to, okay, everyone can see that. The chart on the left, okay, is quite a concentrated exposure into communications and consumer discretionary, a combined total of 70%-ish. Just now, Mr. Zhang did mention as well. So this encompasses digital transformation, entertainment, logistics, consumer AI adoption, all the hot themes that we have recently. Everyone's talking about it, So we have the heavyweights, as mentioned earlier as well, like Tencent, who's investing into AI, gaming infrastructure. We have SMIC, semiconductor manufacturing. Quite a very important chip maker actually. JD, Ali, Meituan, growing and transforming logistics, cloud, lifestyle tech, and EVs, yes, all of which I'll cover a little bit more later. So I just want to show you what the bulk of it is. So they are the digital giants, so to speak, and the key leaders, and you can get them all in this ETF. So before moving on to the individual, let's talk about a different ETF first, the next one. Okay, so moving towards a little bit more of a balanced portfolio play, okay, is the CSOP Hang Seng Index ETF 3037 Hong Kong. Okay, so this tracks the Hang Seng Total Net Return Index. So you're looking more towards broad-based exposure to the Hong Kong top companies across banking, insurance, consumer staples, and more. We'll go there shortly. So this ETF will be more geared towards you if your stance is like, oh, Chinese recovery, stability, good diversity as well. So looking at the numbers for the 1 year return, 37% is significant of renewed confidence in the market. Okay. Even with the year to date sitting at about 7.4% is still a good sign. So although the Hang Seng Tech has the spotlight, the broader market has actually been slowly, silently climbing in the background. So if you've noticed, there's a 1 month dip. Okay, it's not all green. So there's a 1 month dip in the performance. So this could also be attributed to some market consolidation after a rally. Good for us, and might actually present a better entry point as well. Okay, with a lower downside potential. So if you are looking more into broad China Hong Kong exposure with a lower volatility and moving towards a strong recovery theme, you definitely can consider this 3037. Moving on. Okay, so you can see that this one's a little bit more spread out compared to 3033. So let's look closer at 3037. The difference now is that this is not too much of like a sector specific play. Okay, it's more broad based, built to represent Hong Kong's biggest and most influential offerings. Okay, so financials do still dominate with like 33%, which is also to be expected because of the their banking and insurance presence in Hong Kong. So like HSBC, AIA, we heard of all these. They're here in Singapore as well, ICBC. Okay, communications and consumer discretionary follows after financials, with the big names similar to earlier like Tencent, Meituan, Alibaba. We hear these a lot. We'll talk about them as well. Okay, tech, energy, real estate are also present here. Um, so for participation without overexposure into these sectors, okay, you can use this for diversification across the finance, the tech, telecoms, retail. Okay, like basically all the foundations combined into one ETF. Okay, very convenient. So now I want to move on into some of the top holdings in the ETF. Okay, some of us might be wondering, okay, or even while I was preparing, I was also thinking about this. So what are these companies doing? What do they have? Or what are these AI things that they're showcasing that could make an investor confident in them, leading this AI race? What edge or innovations could these companies be developing that will increase this consumer investor confidence and spark a recovery and growth of the China Hong Kong markets? So I just want to start with Tencent. Okay, every one of us knows Tencent. If you play games, you know Tencent. Anything, any media related, you will know Tencent as well. Okay, so these products that you see here, okay, some of these might be unfamiliar to you, so I just want to explain them a little bit. So the Hun Yuan, the T1 model, and the Turbo S, okay, the first and third point you can see there are basically large-scale AI models with more than 389 billion parameters. And the T1 model, okay, the first one, has actually been integrated into more than 50 of Tencent's core products, okay, which enhances capabilities of their products such as code generation, mathematical reasoning, and processing of long text. Okay, the Yuanbao chatbot, the AI chatbot, the second one, also incorporates this T1 model. And for those who are more familiar with AI, like you've been reading a lot into AI, okay, you will know of this benchmark called the Massive Multitask Language Understanding, okay, which basically evaluates the capabilities of LLMs, large language models, how smart they are. So you'll be interested to know that the Hunyuan scored 87.2 on this, okay, against DeepSeek R1, which was the AI model that blew up the whole market. Okay, DeepSeek R1's score was 84. Yeah, was 84. Okay, although the Hunyuan is higher than the DeepSeek, the R1 model, okay, it's still slightly lower than the ChatGPT, OpenAI's GPT-4o, okay, which I think is 88 or 89. Yeah. Okay, so Tencent has also introduced AI services built upon this Hunyuan model, okay, which allows text to images and 3D visual generation. Where we see on social media a lot of people are using this, which of course can assist their game studios and aid in a lot of their content creation as well. So lastly, of course, they are also investing heavily into AI infrastructure, including computing, storage, networking solutions to support development and training of large AI models. Okay, now earlier on I mentioned SMIC was an important like chip manufacturer, everything. So why is because they are producing Huawei's latest chip, which is the Ascend 910C. You can see in the first point here. It's also a kind of a testament to the effort that China is putting into developing their own domestic alternatives to these all the foreign AI chips, which we will still, which of course they still incorporate. The other companies still use it, but yeah, they're trying to put in effort into developing alternatives. Okay, and although one more thing is SMIC also kind of circumvents the US export restrictions, which makes them lack access to this. If you're wondering what this DUV instead of EUV thing is actually, is because they lack access to the equipment that does this thing called EUV, okay, because of all the US export restrictions. So EUV is extreme ultraviolet lithography, okay, which is needed to create advanced chips. So they need this. So instead of using EUV, they have something called DUV, okay, which is deep ultraviolet lithography. Okay, I mean a bit complex, okay, but basically what I'm trying to say is they found an alternative, okay, with another one of the processes to achieve similar results. Okay, so I'm not too well versed in the exact production specification, but they made an alternative, they tried and they got closely similar results. So although this all sounds great, it's still worth a bit mentioning that in 2024 they did report a 45% drop in net profit due to increased production costs and geopolitical pressures. But we are focused on the future. Okay, they're looking to circumvent. So I want to move on to Alibaba. Okay, so if you haven't heard of the Tong Yi Qianwen, that's quite normal. You should know this upgraded version of the previous large language model, significantly better. Okay, it outperforms OpenAI's GPT 3.5 and is on par with GPT 4 Turbo. Okay, in Chinese language tasks. Okay, it also now powers Alibaba's cloud AI services and embedded in this thing called DingTalk, which is like Teams, but it's also a HR portal. Yeah, so to just breeze through, okay, they also release open source models from the Quen family. It means anyone can take it and use it as well. Okay, and they also use AI for e-commerce, supply chain management, product recommendations like your algorithm, okay, and customer service across Taobao, which a lot of us like, and Cainiao, which many of us don't use. Okay, so but it's very famous in China. Okay, so they're also building a GPU cluster on Alibaba Cloud, okay, which aims to support more than 10,000 developers as well. Okay, so Meituan, we don't hear often Meituan, but they are expanding. So they have their own LLM. It's called Longcat. Okay, so they aspire to rival Alibaba's Quen. So it's all competition over there and fight against ByteDance Doubao. Yeah, basically their own AI large language model. Okay, and if you haven't seen the video, Meituan actually has drone deliveries, more than 450,000 successful deliveries. Okay, it looks pretty cool. You all can check it out. Okay, so a fleet of autonomous delivery vehicles, which they are expanding and improving using AI, okay, that can navigate complex environments and more complex areas. Also investing a lot into AI infrastructure for training and deployment of AI models. And they're building AI teams in Silicon Valley, okay, recruiting top talents to compete on a global scale, the AI, to compete for the AI, strongest AI titles on a global scale, okay? And they have an international brand expanding as well. Okay, it's called Kita. It's not in Singapore yet, but it's actually in major cities in Saudi Arabia. Okay, now you'll see here there's 3 EVs, okay? So I just want to talk about EVs for a second because they're a pretty big team, okay? And they're very, very into the whole AI initiative. So Li Auto, not very common in Singapore, you see them here and there, okay? But they are evolving themselves to become an AI-driven company, integrating advanced technology into their vehicle lineup, okay? They're pushing for advanced robotics and autonomous driving, okay? So in the aspect of developing autonomous driving, they have this thing called Mind VLA, Visual Language Action Model, I think, yeah, to enhance their auto driving. Okay, so one nice thing is, if you all use OpenAI, you use ChatGPT, and then you ask it to reason, okay, like tell me what you're thinking. So to increase trust, the Li Auto actually is doing this as well. They will visualize the reasoning behind its decisions on the screen for the driver. Okay, so of course, in their endeavor for high-level auto driving, they have also integrated an NVIDIA system on a chip, NVIDIA Orin, I think, to enhance the vehicle computing power. So it's like very, very smart. Okay, and the CEO has also separated responsibilities. Okay, for the automotive business and AI initiatives. So he is actually going to be like, oh, I'm in charge of AI initiatives. We're going to be there's actually people who are split specifically for AI initiatives. Okay, so I don't want to take too much time. So we move on to Xiaopeng. This is the most superhero company on this list. Okay, They have this thing called the Turing chip. Okay, it's also meant to power autonomous driving and allegedly, okay, 3 times more powerful than NVIDIA, the Orin X, which I briefly mentioned earlier. Okay, so they have a lot of, they also have their AI tech tree strategy along the release of the new car, the Xiaopeng X9, okay, which comes with the Turing, the AI chip, okay, and they also have like 70 billion parameter AI model to enhance your auto driving experience, and of course wants to globally provide for driving capabilities, AI driving capabilities, okay, and they have this thing called it's called Iron, okay, and it's a humanoid robot, okay, that they want to invest a lot into the robot industry over next, and it can work in like factories and things like that, okay, and of course why they're so superhero is that they are still venturing into aerial mobility with an all-electric flying car concept which has like 4,000 pre-orders already, and they want to mass produce it by next year 2026. Okay, now moving on to BYD, the world's leading EV manufacturer, okay, aggressively integrating AI into their operations. Okay, they also have a driver assistance system known as God's Eye. Okay, and it's included in all their vehicle models across all the, and they also partnered up with DeepSeek, okay, to enhance vehicle intelligence well and incorporate DeepSeek into their newer models. Okay, also working with TSMC and MediaTek on a controller chip which would further increase uh, the auto driving and auto parking capabilities. Now you can just press a button and park. Okay, yeah. And they also want to double their sales outside of China, more than 800,000. Okay, this year, their 2025 financial year. Okay. And also they have a joint development with Aramco, I think, to explore collaboration in developing new energy vehicle tech and environmental performance. And lastly, China Mobile, okay, integrating AI into telecommunications. I want to just breeze through this, okay. They're looking towards 6G networks, focus on AI integration that will basically create self-managing networks that reduce their operational costs and enhance their efficiency as well. Okay, so the last ETF, okay, don't go away. I got one last ETF for you. Okay, so we move on to China. Okay, the CSOP FTSE China A50 ETF 2822 Hong Kong, simple gateway to the onshore A market. Okay, features the 50 largest and most liquid companies on Shanghai and Shenzhen. Okay, 2822 gives you the basically the economic backbone, which comprises of banks, infrastructure, and even a bit of energy as well. So while the short-term numbers, you see a lot of red, then you may be a bit unhappy. Okay, it may look a bit mixed. Okay, but this ETF is a strategic role for investors who want to position early in China's domestic resurgence. Okay, so to understand what you are buying with 2822, let's look at the companies. Okay, they're not just big, but they're essentially like critical to the economy and they're closely aligned with the policies as well. Okay, so we see the sector weight, financials are like a third of the portfolio with China Merchants Bank, ICBC, Ping An, and the like, you know. So these are the cornerstones of the finance. Okay, very aligned with government policies and monetary easing cycles, which we are all very focused on, especially if you are Chinese investing in the China market. Okay, then we are multi. Okay, people like to drink. This is your thing. Okay, and BYD is here. You know, EV leader, and Amperex, one of the battery giants for EVs. Okay, don't forget if CATL. Okay, they might have a IPO in Hong Kong this year. Okay, pre IPO with Williams. Okay, so when it comes out, you know, okay, it's a very big thing, okay, and Yangtze Power, okay, to get the exposure into energy and infrastructure, okay. So if you're looking for exposure into China, consider this. So I've just walked through these three ETFs, okay, and I just want to conclude, okay, because I've taken up a bit of time, okay, so that you can just briefly position them in your mind and your portfolio, depending on what kind of investor you are and what you're trying to achieve in this current market cycle. Okay, so if your conviction is China's innovation, AI, digital platforms, chip development, cloud, this is your high growth, high upside ETF 3033 Hong Kong. It's made out of the big names that I mentioned earlier. Okay, good for investors who are okay with a bit more volatility in exchange for the potential to ride the next tech wave out of China. Okay, if you are the kind of investor that says, I want to be early on the next wave, you can consider this ETF. Okay, so 3037, I talked about this earlier as well. It gives you something a bit more stable. Okay, it leans into the blue chip corporates, the large banks, telecom giants, industry leaders. Okay, this is your steady ETF. Okay, ideal if you want to participate in the China recovery team, but a bit on the lower downside risk. Maybe you don't like too much risk of volatility. So think of it of a core, like a core holding that's not so flashy. Like tech AI. But it holds steady. So this ETF is like the backbone I mentioned earlier, and it's the middle ground between growth and resilience. Okay. Lastly, you've got 2822, which is also a pretty broad play. So if you're thinking long-term-ish full market exposure and you don't really want to worry about picking themes or sectors, then this is your one-click Chinese allocation, passive, diversified, low cost. Whether it's banks, green energy, healthcare, or industrials, you get it all. Okay, so you're building a portfolio for a long haul and you want exposure to the economy without having to steer all the twists and turns. This is your go-to. So just hop on and stay the course. Okay, so depending on your risk appetite and your view on the Chinese market, okay, if you're growth hunting, value seeking, or you're building a portfolio for the long term, there's an ETF here to match your strategy. Okay, so whichever path that you take, it's a good thing that you're taking action now. Okay, and not waiting while the recovery train leaves. Okay, so just a simple one. You can just take a screenshot. Everything that I've said in the past 5 minutes condensed into this. Okay, so you can just take a look at this. Okay, take a screenshot, take a picture. I'm just gonna wait in 3-5 seconds. Okay, so now, of course, this is not all that is being offered by, there are so many other ETFs out there. Okay, so I just want to show there's so many new. Okay, here's a broad overview of all the other ETFs that are being offered as well. You can see 3033, 3037 at the top. Okay, and of course, but this is one of those. Like, I just want to show you that there's a lot offering here by CSOP for all the different ETFs and all the sectors. Okay, and one of those things is we have a lot of active traders. Okay, so here's a quick summary of all the LNIs that are offered by CSOP. There's Berkshire, Nvidia, Tesla, Coinbase, Bitcoin, MicroStrategy. Okay, if any of these catch your fancy, okay, you can learn more at their website, or you can drop us an email to find out more as well. Okay, for LNI ETFs, I must stress, do kindly make sure you fully understand the product before you start investing. Okay, so before we move on to a quick Q&A, I would like to introduce everyone to our Mobile Tree communities on our new and improved Poems Mobile Tree app. Okay, so if you want to be involved, okay, I'm just going to go through this really quickly. Okay, you can scan the QR code here and download our app to join our communities today. It should take you directly to the App Store or Google Play. Okay, and if you're wondering what can I see down there, okay, here are some of the posts, and these are all the communities on the left. You can see options trading, our bond team is there as well. Growth stocks, technical analysis, ETFs, they're all discussed here. Okay, with my team also, we talk about like a lot about Hong Kong as well. Okay, and you can see here ETF news, technical analysis. By the way, if you go to technical analysis and you ask, you can get they like take requests from you. So I highly recommend. Okay, there's US Kerning calendar as well. It's one of our client favorites. Okay, so just show this one more time. Okay, if you want like-minded investors, you want to talk about stuff, we have community surveys, we have all the good stuff there. You can scan this QR code and it'll bring you right there. Okay, now quickly. Well, if let's say you can just search Poems Mobile Tree on your Google Play or App Store lah. Okay, so if Telegram's more your thing, scan this, it'll bring you to Telegram. Same thing, we got so many different ones I want to show you all, but we're a bit pressed for time. Okay, so now, for all of you who have questions, now is the time to put them into the Q&A session at the bottom of your screen so Mr. Zhang can see them. Okay, and hopefully we can
I
take enough
already
time to
saw two questions, one in the chat, one in the Q&A. Maybe I start from the webinar chat. How about I share on some tech ETF? Again, typically we don't directly comment on our peers ETF, but I want to highlight when you trade an ETF on stock exchange, Of course, the size is important. Well, that's one thing. And size-wise, the our ETF 3033 is still one of the world's I think still the world's largest. And it's the one thing. Size is important. But more importantly, since the ETF is listed on exchange, the liquidity is very important. This can be reflected in your trading cost because when you buy a mutual fund, your cost is pretty much the management fee or the TER, the total expense ratio. But when you trade an ETF like an equity, the TER or management fee it's only an annualized number because if you frequently buy and sell, then the trading cost is more relevant. That's why our liquidity is quite has an advantage versus other peers because we have the liquidity. Let's say on every day we have US dollar 200 equivalent to US dollar 200 to 300 million, which means from individual investors to institutional investors, they can easily buy and sell on exchange, and the bid ask is quite tight, and sometimes can be a lower the double digit or even a single digit, which means when you trade, if let's say if you trade every month or sometimes even every week, then your saving from the better liquidity can means a lot to your Hang Seng Tech ETF trading. I think that's how we compare our Hang Seng Tech ETF versus other peer ETF. And also, this is also can answer the question for the A50 one in the Q&A chat because there's quite a few A50 such as CSOP and others, let's say in Singapore. What are the differences, if any? Why CSOP? I think I just want to highlight our A50 is our very first ETF since 2012. Um, the ETF also has a very large size, over 1 billion US dollar, and the liquidity also quite strong, which means yes, it's not hard for peer let's say the issuers to track an index from an investment perspective. You can just fully replicate the underlying constituents. But once it's come to the practice for investors to trade and to buy, then the liquidity and size makes a lot of sense, which means the higher size means a better TER or all else equal, and also means a better underlying trade negotiation power, and also the better liquidities on exchange. And all this will finally translate to the saving of the trading cost and also the better total return, all else equal, to the investor using these ETFs.
Okay, everyone. The time now is 8:01.
Mm.
If you would like to learn more about the ETFs that we talk about, you can always visit the CSOP website, and you can find all the product catalogs over there for you to learn more about it as well. You can also visit our Poems website to learn more about trading ETFs. And with that, I would like to thank Mr. Bruce Zhang for his time today and for all the insights that have been given to us. If anyone has any questions, please do feel free to drop us an email as well. And with that, I would like to end the webinar for today. Thank you, Mr. Zhang, once again. And thank you, everyone, for
Thank
joining
you.
us. Please have a great evening ahead. Thank you.
Thank you.